Hi, I'm Jeff Turnahoy, Head of Americas Research at Lipper, and today I'm joined by Andrey Kutuzov, Senior Equity Analyst on the International Research Team at Wasatch. Andrey, thanks for joining me.
Thanks for having me here, Jeff.
Andrey, your funds were recently honored at Lipper Fund Awards, the International Growth Fund and the Emerging Market Small Cap Fund. Let's talk about the strategies of those funds.
So both funds are focused on investing in growth-oriented small cap companies, with the International Small Cap Growth Fund having a $5 billion market cap limit, and Emerging Market Small Cap Fund investing in stocks under $3 billion in market cap. That being said, the main similarity in the two funds is our investment focus, which is the focus of assembling a portfolio of the best, highest quality, long-term growth companies in their respective market cap ranges in each fund.
Okay. How does the investment process work at Wasatch to find those companies?
We start with screening. Since we're trying to find the highest quality long-term growth companies, what we do is we screen for factors associated with high quality and good growth opportunities. So we look for things like return on capital, return on assets, stable and consistent cash flow generation.
Okay.
Also, of course, prudent capital management. So the company is being run for investors and for shareholders. So we run a lot of screens on that basis, and the screens will typically show us which companies tend to fit that profile better. And then because it's a small cap investment universe, there's typically not a lot of coverage of these companies. A lot of these companies that we're looking at have 3, 2, or 1 sell-side analyst only. Some of them have no sell-side coverage. So basically, once you know which companies you think fit your process, you have to get on the road and travel and meet managements of these companies. And that's really the most exciting part of our job. A typical analyst at our firm spends about a quarter of the year traveling, going to places like Peru or Philippines or Indonesia. And basically you're just meeting these companies, the management teams, and trying to understand if the management team is managing the capital prudently, if it cares about shareholders, kind of what the risks to the business model are, and what the long-term growth opportunities of these companies are.
Why make the argument for small cap right now?
Well, small cap is just such a more fascinating space, in our opinion, for a multitude of factors. First of all, when you look at emerging markets, the small cap space is just vast. There's about 5,000 listed equities in the market cap range between 200 million US and 5 billion US market cap. So it's a very vast space. It's fairly inefficient. There's not a lot of sell-side coverage, especially towards the smaller end of that range, which means that if you do your job screening and traveling extensively, I mean, you can really uncover these companies. It's more often than you'd think that we meet with management teams that tell us we're the first investors to actually meet with these companies. The large cap companies that you typically see tend to be more commodity driven, more export driven, so more of a global growth type proxies. Whereas in the small cap universe, you really have a lot of domestic consumer demand stories or domestic infrastructure stories. So what that means typically is that there's a lot less correlation between these companies in various countries because they're driven by domestic demand factors and not global factors.
Now, you mentioned all the work you guys do to track down the right companies with the right mix of fundamentals and good management. But what about some of the risks that people get concerned about when you talk about emerging markets, political risk or economic risk? How do you mitigate those?
Well, that's a great question. I mean, individually, these countries are extremely different from one another. So, I mean, they have their own unique, idiosyncratic political, economic risks and whatnot. But if you look at it from a portfolio standpoint, because there's so many different countries in the emerging markets and they're so different from each other, if you construct a well-diversified portfolio geographically, the correlations between these countries actually tend to be quite low, especially with our focus on very high-quality companies with strong balance sheets and a culture of paying dividends and returning cash to shareholders. Really, it's much safer than one would think. So just to illustrate with an example, for example, the correlation between OK Group, which is a Russian food retailer that we own, and URC, which is a Filipino food company that we also own, the correlation between those two companies, which are seemingly in a similar industry, is actually negative over the last few years.
Okay. You touched on a couple of countries. Are there others that you're quite fond of right now?
Generally, what we're seeing based on our bottom-up screening efforts is there's a lot of growth acceleration in Southeast Asia that's been occurring now as well as in the last couple of years. So specifically countries like Indonesia, Philippines, and Thailand. We're very positive on them long term because you have very strong balance sheets. As a function of the 1998 crisis, it took those countries a very long time to recover. There is very limited investment, capital investment in those countries. So now with strong population growth and early stages of a credit cycle there, you're just really seeing a lot of pricing power for incumbents. You're seeing accelerating growth patterns. So we're very positive in those countries. Also, some of the smaller LATAM countries have been quite neglected by the broad investment community, such as Peru and Mexico have very solid fundamentals, good balance sheets, and very strong growth long term.
Okay. Well, thank you very much for joining me, Andrey.
Thank you, Jeff.
On behalf of Wasatch and Lipper, I'm Jeff Turnahoy. Thanks for watching.